This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
The aim of integrated reporting is to give a concise view of an organization's strategy, governance and performance, but much wider than would simply be given by traditional financial statements, which concentrates very much on historical financial performance. Really, the idea is that giving the financial statements and this historical information doesn't give very much insight into perhaps the company's future prospects or the risks that it might be undergoing. And to really understand how the company and its future may be set out, you need much more than that. And therefore, the integrated reporting is supposed to demonstrate the link between financial performance and a wider social, environmental, and economic context in which the company operates. It should give some insight into how the company creates value, how we're looking for sustained value over the short, medium, and especially the long term. By setting out much more information and making it available to both board members and to shareholders, it should enable certainly the board members to make much more effective and decisions. By setting out the information like this, more comprehensive information, it should certainly enable the board members to make more effective decision making. It will also improve, of course, the information available to shareholders and allow them to have a better hold on or feel for whether the company is doing good or bad. And it should encourage more integrated thinking amongst the business practices. For example, it might relate public relations or relations with customers, how that is going to give rise to longer term success of the business as traditionally measured by financial returns. The contents of integrated reports are as follows: organizational review and external environment. So let's think about external environment here. You might be in a company which, let's say in the UK, has many imports and exports to Europe, and at the time of this recording we're in the middle of Brexit negotiations, and it would be relevant maybe to how this company is going to do in the future, how those Brexit negotiations turn out, and that should really be mentioned. We need to know the governance, how the company is governed. It would be useful to know about non-executive directors and so on, and how the relationship really between the shareholders, the principals, and the directors, the agents, is actually managed. We'll be looking at the business model, which is effectively how does the business make money? What's the basis on which it's making money? Is it a business which demands really a lot of research and development to keep it ahead of the pack? Is it a business which is making more traditional goods and where there may be great emphasis on quality, but actually the nature of the goods doesn't have to change very much? But it's important that the shareholders understand properly really what makes the business tick. Risks and opportunities. Very important for shareholders to understand what risks may be coming up within the next few years, where the danger areas are, but also where the opportunity areas are, and also to know what the board is proposing to do about both the risks and opportunities. How can you possibly judge how well your investment is doing simply by looking at historical financial results and having no clues at all about future risks and opportunities? Strategy and resource allocation. How are we going to deal with the challenges of tomorrow? What resources are we going to begin maybe piling into training staff, into building a new factory, into putting more money into research and development? Are we going to be thinking of getting into a joint venture with another company, which maybe enables us to spread the risk and to share the finance? Performance. How do we measure performance? Not just financial performance, but other aspects of performance. Maybe like the esteem or the regard or the way in which our customers like or dislike us, how they value us as suppliers of vital goods. The outlook, and really the basis then of preparation of the integrated reports. Integrated reporting talks about 6 capitals. The first is the financial capital, which is, I suppose, the traditional capital where, as accountants are used to. It'll be looking basically at the statement of financial position, seeing the assets which are present there, seeing the liabilities which have to be spread, having some idea of how safe we are maybe as regards to current ratios and cash flows and the like. However, companies also rely on manufactured capital. Think of manufactured capital as really the non-current assets. How are we in terms of our non-current assets? Are they modern? Are they up to date? Are they going to be doing what we need to be done? Intellectual capital. For example, patents that we own. Do we put money into research and development which builds up the intellectual capital, the know-how? Can we sustain ourselves by being able to make products better than our competitors because we have this good intellectual capital? Closely allied to that is the human capital. What type of staff do we have? What sort of training do they have? What talents do they have? What are we doing to make sure that staff stay with us and don't move maybe to a competitor, taking those talents and know-hows with them as they go? How do we make sure that we remunerate staff appropriately to reward them for performing well? Social and relationship capital. Think of this as how we get on with our customers. Do our customers treasure us? It could maybe be how we get on with the local population. Are we good neighbours? Or are we kind of hated by the local population because we clog up their roads with heavy lorries and pollution? How are we looked upon by government? Public sector contracts can be very large, and if government distrusts us or doesn't like us, then that could be bad news for us. And finally, natural capital. Not every company will make great use of natural capital, but an example would be, a very easy example would be an oil company. An oil company has presumably got natural capital in reserves of oil, which is hoping to drill for. If you're in an agricultural business, the type of land which you have and whether or not it's productive is part of your natural capital. Natural capital can also come in to what use or how you're dealing with your carbon footprint and be able maybe to offset the use of carbon. Environmental and sustainability accounting. Companies are increasingly encouraged to report on their impact on the environment, or to be able to demonstrate that they are taking their impact on the environment seriously. And 2 approaches are mentioned in your syllabus. One is the EMAS approach, Eco Management and Audit Scheme. And the important thing here is audit. This is going to be a scheme that you can register with. You can put environmental schemes into effect, or initiatives into effect, and this can be audited, and then you can be awarded a kind of certification that you are, if you like, taking steps to improve your environmental impact. So basically you have to evaluate what you're doing, what impact you're having on the environment, and how you're affecting the environment. You then report that, and then you improve it. So if you evaluate it, you report it, and you show steps to improvement or a plan to improve it, then you can be basically certified under this scheme. And apart from it maybe being good in itself, it enables you maybe to publicize this and get good public relations from customers, suppliers, shareholders, the government, the media, and so on. Closely allied with this is a series of international standards organization initiatives, the 14,000 series, which are international standards on environmental measurement. For example, telling you perhaps how you should measure your impact on the environment. These initiatives are very much part of the kind of evaluating and reporting and improving here. They will support it. It doesn't provide you with any form of certification. It doesn't necessarily get you to evaluate your start point and your end point and show an improvement which is going on then there. But nevertheless, they provide standard ways of dealing with environmental and sustainability accounting. How do you make the measurements, basically, is primarily what these are interested in.